Hello and welcome to Indianomics. We are approaching the end of 2017 and the world's gaze is on 2018. The world economy in 2018, that's the report we have from Nomura. So we kick off our world economy in 2018 series with the creme de la creme of Nomura. How will the world economy shape up? How will the Asian economy shape up? And how the Indian economy will shape up. I have with me Rob Subbaraman, who is of course directing their emerging market economy research, Sonal Verma, a familiar face for us in India, and Yang, who is the China expert at Nomura. Gentlemen and lady, thank you very much for joining me. Well, first up, Rob, as we step into 2018, are we going to see a crunching of global central banks' balance sheets? And therefore, should we worry about dollars and financial interests fleeing Asia and India?
So I think it's going to start the year with the Goldilocks economy continuing. So the strong growth and still low inflation. But to your point, I think as we get into 2018, the risk we see at Nomura is that the big central banks are going to start normalizing monetary policy faster than the market thinks. So we're forecasting the Fed to hike rates this month, and then 3 times next year will continue to reduce its balance sheet. But the surprise could be the ECB. We're very bullish on the Eurozone economy, and the ECB has announced that it's going to start to reduce its bond buying start of the year from 60 to 30 billion euros and buy 30 billion euros of bonds every month through to September. We think it will renege on that, and around the middle of the year it's going to say, hey, the economy is growing so strongly, we're going to have to stop our bond buying program altogether in September. And our sense is that even the BOJ, where our base case is on hold, continual QE, the risk is it might also start to unwind. And Asia and EM is vulnerable to that, because over the years it's all been hunt for yield, and that the yield is in Asia. If that QE starts to turn to QT, quantitative tightening, Asia could see outflows.
That's my point. You're speaking of 4 rate hikes from now till the next December.
Yes.
That will mean a US 10-year which will definitely be over 3%. Possibly. Won't that impact yields in Asia as well, push them up, and therefore, constrain growth? After all, credit gets expensive everywhere. Won't that impact growth in Asia and India?
Well, we don't expect the US 10-year yield to actually go over 3% because, we think after next year, 3 hikes, the Fed will be almost done. So it's not like it's going to continue every year. So end of 2018, we have 2.8% for treasuries. So there could be some snapback risk for some of Asia. And parts of Asia do have attracted a lot of inflows and have high debt levels, could be exposed. But I think it's actually, if you look across Asia, the key is don't treat Asia as one homogeneous region. I think there's going to be differences, and I would point to what we are starting to affectionately call Asia's tiger cubs. Okay. And India particularly is one of those cubs where we're actually optimistic.
Okay. This has long been an Indian dream that, the tiger economies are there and we should get there. So, well, this is the first time somebody is actually calling India at least a tiger cub, if not a tiger. I'll come to that in a minute, but let me get Sonal's view on what Rob is telling us. If there are going to be 4 Fed rate hikes, how do you see the Indian yield picture? That would be a response to some kind of global inflation as well, probably US inflation rising over 2%. How would Indian inflation, pan out in such a global environment where there could be global and Asian inflation?
Well, actually, the normalization we're expecting globally is not so much driven by inflation exceeding the 2% target. It's sort of more, in specific cases, financial stability risks and more normalization because of greater confidence around growth. So we are not projecting, significant pickup in global inflation. So that's the backdrop. Now, I think for us in India here, if the global demand does remain strong, there will be, of course, some slowdown in China, but we're expecting oil prices to remain around $65 on Brent. So there will be some price pressure from that perspective. We have to be on the guard for any risk of capital outflows if it happens, which, like Rob said, could start to happen in the second half of 2018. But I think the bigger risk for us is more domestic. Because in the last 12 months, we've seen a significant correction in food prices to a level where the incentive to produce has become a disincentive, and you've seen production being cut back, and the response would be to cut supply, which leads to higher prices going forward. So I think we're coming from a period of very low food inflation. We're coming from a period of very weak demand, and that we're getting into a period of stronger demand, and the adverse impact of low inflation on production and future price response would be there. So I think those are the bigger risks we face going forward.
Okay, so do you expect rate hikes in that case from the central bank? At the moment they are neutral and on hold, but do you see inflation going up to 5% and beyond for a better part of calendar 18, and therefore rate hikes and therefore some kind of readjustment of growth?
Well, I think in the very near term, of course, the trajectory on vegetable prices has been so steep that in the near term it looks like inflation will surprise on the upside, but that's more vegetables related, which can reverse.
Even core is 4.6, so
4.6 and driven by
rising.
And driven by the statistical impact as well. So we need to keep that in mind. But to your question, looking into 2018, specifically in the second quarter of 2018, given the base effects are also adverse, we do think, yes, that inflation will be above 5%. Monetary policy response, though, cannot be driven by how vegetables are moving and statistical or headline numbers. It's the underlying. And on an average for the next 12 months, we are expecting inflation to be around 4.6%. Now, in the past 12 months, despite inflation undershooting, the Reserve Bank did not deliver the kind of easing that was expected, essentially to not flip-flop on policy. So we think that there is sufficient real rate cushion to absorb the inflation increase. Of course, with growth picking up, inflation risk picking up, oil a bit on the higher side, the G4 normalization, perhaps the tone becomes a bit more hawkish as we go through the year, but we don't expect tightening.
Okay, what's a growth number then? So for the FY18 and 19?
So for FY18, we are looking for GVA growth around 6.4%, and for FY19, we are expecting a pickup to about 7.4%. Okay. So we are looking at a recovery going forward.
Okay, so RBI will have to, much lower than the RBI's forecast.
That's right. We think there's downside risk to the Reserve Bank's numbers, though.
Okay, at the moment, the Reserve Bank is lowering, and even you are lowering the growth forecast and increasing the inflation forecast. What you are actually saying is that this will reverse in FY19. Growth will be higher and inflation will be lower?
Well, FY18 on an average, though, inflation has still been a 3.5 handle. So if you compare that to FY19, we are talking about, slightly above 4.5%. So given the growth recovery, given, the risk on reversal on the food side, given the view on oil prices, we do think that, the average inflation as well as the average growth number in the next 12 months will be higher.
Okay, but it's still good to hear 7.5%. That's now become almost ambitious. There was a time when we thought 8 was par for the course, but now 7.5 is becoming a stretch, and it's good to hear that from Sonal. Before I come to the China angle, which I think is going to be a very important talking point in 2018, one more factor from the United States. The tax reform bill indicates that there is going to be a lot of advantage for corporates which bring back money to the home country, to the United States. Doesn't that mean a very strong dollar? Won't that have a concomitant impact on the way smart money moves?
I mean, it could have, I think, a modest effect on the dollar. But don't forget, a lot of the cash that US big companies are holding overseas is already in US dollars. So we don't think that inflow will have a a very big impact on the dollar.
I'll come back to the global and the Indian scenario in a minute. We have to take a break, but China, not very long back, just about, say, 18 months back, 20 months back, was a very important destabilizing factor with the fear that there could be a lot of Chinese yuan devaluation. So that question to the Nomura team after a very short break.